Welcome to UnEarthed Financial. Today I'd like to talk to you about managing your risk within the financial markets. Now, the exciting thing with the financial markets is that you can actually predetermine down to the cent exactly how much you could potentially lose on each trade. Now, I think that is really, really exciting because so many people think that the financial markets are risky, but what they don't understand is that that risk can be predetermined. So risky to me is something that's unmeasurable. But when you understand exactly how much you can lose on each trade through proper risk management strategies, it's simple. It's a no-brainer. You can manage it effectively. You can reduce it if you need to, or you can turn it up if you want to turn it up a bit more. Anyway, let's have a look at a few strategies that I could share with you. Unfortunately, many people even call trading or investing in the share markets gambling. And the reason they do that is because most novices, which is around about 90% of people who trade in the financial markets, will actually buy shares or get into currency trading and enter the market and not even place a stop loss or not even have any effective position sizing. So essentially, they are overexposing themselves and are really dangerously trading. So let's have a look at some simple and clear steps to keep you safe in the financial markets. I suppose, first of all, we need to look at what is effective risk management in the financial markets. And that is knowing exactly how much you could potentially lose on each trade. And that's, like I said, it can be predetermined and you can know down to the cent. And if that figure of money is not, if you're not happy with that, reduce the amount or don't take the trade at all. Now, the way to manage your risk is through 5 easy steps. Now, the first one is to make sure that you trade with a stop loss. And I'll go with you a little later on. I'll go through each of these points and explain to you exactly what they are. Number 2 is limiting your loss through effective position sizing. You don't want to spend all your money on the one share or put 50% one share and 50% in the other share, and if you lose on both of those, effectively all your money's almost gone. So number 3, taking profit along the way. Number 4 is using a trailing stop loss to protect those profits as the trade moves in your favor. And number 5, another way is moving your stop loss to at least break even so that you have totally removed the risk on the trade. So what is a stop loss? Now, a stop loss is attached to your entry order. And what it means, it's a price which is really your worst case scenario exit price. Now, I've got an example here, assuming that you purchased, I'm just going to use shares rather than currencies or anything like that because most people understand the share market to a certain degree. Now, let's assume you purchased or entered into a stock and you wanted to trade the market long, so the market would need to rise in your favor to be able to profit from this trade. Let's assume you entered in at $10. Your stop loss could be placed at, say, $9, which is $1 below your entry price. And that means should the market not go up, but instead go down and go against your favor, you would be exiting worst case scenario at $9. You don't want to lose any more than $1 per share. Okay, so now we know that we could potentially lose on this trade $1 per share. But we need to figure out how many shares do we buy in the first place. Now, that can be done through position sizing. And this is looked at through determining how much of your overall account, what portion would you be prepared to risk on each trade? Now, as a general rule of thumb, traders use somewhere between a 1% risk on their account to a 5% risk. Look, some people use higher, like a 10% risk or a 7% risk, but generally it's somewhere between 1% and 5%. 1% being the lower risk, meaning that on a $10,000 account, that person doesn't want to lose any more than $100 on each trade. Now, I'm going to use, in my example, I'm going to use a 3% risk, which is somewhere, middle of the road. So if I had $10,000 in my trading account and I didn't want to lose any more than 3% on every single trade that I placed, how I would work out my position sizing is through this calculation that I have here. So 3% of $10,000 is $300. So I do not want to lose any more than $300 on each trade. So how do I work out how many shares that I buy? Well, I simply divide the account risk by the trade risk. So my trade risk is $1 per share. So I divide $1 into $300 and it comes out at 300. So I can enter into 300 shares risking $1 per share to not exceed my maximum risk of account of $300 or 3%. Now, another really excellent strategy to use while you're trading, where you can either reduce or totally eliminate the potential risk of the trade that you're in, is taking profit along the way. And what I mean here is I'm not saying that you need to close out your entire position, but instead just close out half the position and then you actually put your trade into a break-even status. And what I mean by that is, let's go back to our share trading example where we entered the market $10 and we had our stop loss at $9. Say if we actually placed our profit target at $11, we would essentially be taking profit at $1 per share. So if we had 200 shares in this trade example and we sold out 100 shares at $11 profit, we've just made $1 per share on those 100 shares, which is we've got $100 in our bank account now. Now, if after that point in time the market turned around and hit our stop loss, we're at $9 on our remaining 100 shares, we then are losing $1 per share, which is we've essentially lost $100. So we're at break even. We've made $100 and we've lost $100. So essentially we're at a no win, no loss scenario. So as you can see, it's really important to take profit along the way, because what you've just done is simply eliminated the potential risk, and you can sleep easier at night. There's nothing that's going to actually happen to you. You may lose a little bit of brokerage, but that's about it. Because the worst thing that can happen is that if you were to close out your entire position, we've had a few traders here that have done that in some of the index trades and missed, they might have closed out with a few $100s in profit and missed out a $20,000 profit, which was, you can kick yourself when you do that. So it's about reducing or eliminating the risk and then still having cards on the table so that you can still play the game. So, there's the whole argument, if you're not in the market, you're not losing any money. But again, if you're not in the market, you're still not able to make money either. So it's about managing your risk effectively through strategies such as these so that you can play the game safely. You may have heard of a trailing stop loss before, and what that simply is your initial entry stop is just moved up as your trade moves into profit. It is just moved up in line with your profit. Not too close, not too far away, because you don't want it too close and unnecessarily get stopped out. But it can help either, again, eliminate risk totally or reduce it as you go along. So at Unearthed, we will regularly give trailing stop losses to move under your position so that you protect as much profit as possible, and you just, avoid any adverse market movements, because sometimes markets can quickly change direction, and the last thing you want to do is watch all your profit go. So, it is a bit of a touchy scenario, because you don't want it, like I said, too close to the current market action that you unnecessarily get stopped out just through normal price fluctuations. But you don't want it too far away that you watch all your profit go up and then come back down and get stopped out without really keeping too much in your pocket. So I hope you've enjoyed watching these strategies, and please do email us should you have any questions at all with regard to these, because by effectively using all of these different areas, you will significantly increase your profitability and sleep easier at night. And that's the most important thing. You really want to make sure that you are detaching your emotions when you're trading, and this is done via managing your risk. For listening, and please do visit our website.